All right, Gilbert, we don't talk about Japanese bond yields a lot. As we mentioned earlier in this show, in multi-year highs dating all the way back to mid-2000s. Why are these yields important so right now?
Well, there's a couple of quick things. I think it's important to recognize that the outlier really is a 30-year bond, because if you look, things like the 10 to 30-year spread there in Japan is essentially twice the normal spread over the last 25 years. Instead of it being roughly 85, it's now almost 160. So really all the action over there is really happening in the 30-year. And I think what's also important is to recognize that they've gone through a period of yield curve controls, keeping rates artificially too low, and really going through a period of deflation. And I think that's all now coming to roost. And you can see that deflation, Frank, if you look at their stock market, it has been over the last 25 years a return of essentially zero or maybe 1% compared to our market, which is about 10% annualized. Go ahead.
All right. So you're saying it's all coming back to roost. So what is the impact we should all be looking for? Obviously, the low yields led to the Japanese carry trade. Estimates out there, it's about a $500 billion trade. And the thought is if the yields rise, that money's going to go from the U.S. back to Japan. Now, is that why this is important, or is there some other facet that you're looking at?
Well, I think what's really interesting is we kind of have the other side. In other words, I believe just like we had the bond vigilantes back in the early 80s and in the essentially the 90s, I believe it's the bond samurai. And what they're doing is they're trying to say to their government, we cannot afford right now with our high GDP to debt to GDP ratio, we cannot afford significant stimulus. We need to slow down the quantitative tightening, and we need to go back to adjust the issuance, where before they were issuing more on the short end, now they're issuing more on the long end. I think the bond samurais are telling them what they need to be doing, and I believe if they don't listen, rates are going to go even higher. And I believe what that would do is lead to a slowdown of their economy, a significant one, which will ultimately flow back into a slowdown here in the U.S. So that's really the impact. I think it could be to a real detriment to their economy and a slowdown, which would flow back here into the U.S.
All right. I do want to point out, we're looking on Kalshi right now, 93% chance of a 25 basis point hike. Also want to mention CNBC and Kalshi. They also recently announced a multi-year agreement, which includes the use of Kalshi data for editorial purposes as well as commercial components. So strong chance of this happening, according to Kalshi, very strong chance. So if it does happen, is this one hike? Does that set up the scenario that you're talking about? Or if there's more hikes, if this is a series of hikes, is that the issue we should be worried about?
I think this is going to be just a series of hikes. I think this is just the early stages. And I think a lot of the carry trade has probably washed out last year. There will be more washing out as we continue to lower our interest rates and they continue to raise their interest rates. And I think that whole the carry trade will go away. Ultimately, this is just a normalization of their monetary policy, which is really long overdue.
All right, one other point. You say the real rates here in the U.S. are actually more attractive than Japan. So it sounds like you think that's going to keep the money here?
That is correct. And I think in reality, I think that's going to be the backdrop to keep rates going much lower here in the U.S. If you look, our real rates are roughly about, on the long end, 100 basis points too high. And so that's going to be the catalyst for either A, a continued slowdown in this economy, or else we're going to need to get those real rates much lower in the near term pretty quick.